The US national debt has blown past $35 trillion, and the storm clouds are getting darker. This isn't just a big number on a government spreadsheet. It's a force that could shake global markets to their core. Stay with me until the end, because the real danger isn't just the size of the debt. It's the chain reaction it could set off. Right now, America's debt-to-GDP ratio is at historic highs, meaning the country owes far more than it produces in a year. Interest payments alone are projected to hit nearly $870 billion next year, more than the US spends on national defense. That's money that can't go to infrastructure, education, or innovation. So how did we get here? Decades of budget deficits, tax cuts without matching spending cuts, costly wars, stimulus packages, and rising entitlement costs like Social Security and Medicare. Both political parties have contributed, and neither has shown the will to reverse course. The problem isn't just domestic. US Treasury bonds are the backbone of the global financial system, held by governments, banks, and investors worldwide. If confidence in US debt weakens, the ripple effects could be catastrophic. Here's the first risk: higher borrowing costs. If investors demand more yield to hold treasuries, interest rates across the economy rise. That means more expensive mortgages, car loans, business financing, and credit card debt. It also means the government pays even more just to service the debt, creating a vicious cycle. Second risk: crowding out. When the government borrows heavily, it competes with the private sector for capital that can push up rates and slow investment in businesses, stalling economic growth. Third risk: currency pressure. If debt levels scare investors, the US dollar could weaken. That might boost exports, but it could also raise import prices, fueling inflation. And then there's the nightmare scenario. A technical default, even a short one, could shatter the perception of treasuries as the safest asset in the world. That would send shockwaves through global markets, from stocks and bonds to commodities and crypto. Now, I want to hear from you. Do you think the US can grow its way out of this debt? Or are we heading for a reckoning? Drop your thoughts in the comments. And while you're here, hit subscribe. We post every Tuesday and Friday, breaking down the forces moving stocks, crypto, and the economy. Back to the storm. Some analysts warn that high debt levels make the economy more vulnerable to shocks. A recession could slash tax revenues, forcing even more borrowing. A spike in interest rates could make debt service costs explode. And geopolitical tensions could make foreign holders of US debt rethink their exposure. China and Japan are the two largest foreign holders of treasuries. If either started selling in large amounts, yields could spike, and markets could panic. There's also the inflation factor. If the Federal Reserve is pressured to keep rates low to help the government manage its debt, it risks letting inflation run hotter. That erodes purchasing power, hits lower-income households hardest, and can destabilize markets. Some point to history. After World War II, US debt was also very high, but strong economic growth and inflation helped bring the ratio down. The difference now is slower growth, an aging population, and massive unfunded liabilities. So what are the possible outcomes? 1. Slow grind, where the debt keeps growing, but markets adapt until a crisis forces change. 2. Inflationary reset, where the debt is eroded by higher inflation, intentionally or not. 3. Fiscal reform, where spending is cut and revenues are raised, politically painful but stabilizing. 4. Financial shock, where a sudden loss of confidence triggers a market crash. For investors, the key is to watch the bond market. Rising long-term yields, widening credit spreads, and unusual moves in treasury auctions can all be warning signs. Diversification, holding assets that can perform in inflationary or deflationary environments, becomes critical. The $35 trillion debt isn't just a number. It's a pressure point on the entire global financial system. And the next few years will determine whether it's managed or whether it breaks something big. Thanks for watching. Like, share, and subscribe. And tell me in the comments what you think the real tipping point will be.